When you're investing for the long haul, for years, history really, really matters. I'm not talking about just one good year, but a whole decade of performance through all the ups and downs. Today, we're going to climb the ladder of the last decade's most powerful, most popular ETFs to see what truly came out on top. So, what does it actually mean to be a winner over 10 years? Is it just about chasing the biggest, flashiest number you can find? Or, is there a little more to the story? You see, the real test isn't some flash in the pan. I mean, any fund can look good for a year, maybe even a few. But to consistently deliver year in and year out through the good times and the bad, that's the mark of a true workhorse for your portfolio. All right, let's get into it. Here's our path up the mountain. We're going to start with the global foundations, then build up to the American core, and then we'll really hit the accelerator with the high-growth strategies that basically define the decade. It's all leading to your investing blueprint. Let's start the climb. Okay, our ascent starts with a super important base layer, global diversification. Coming in at number 9 is VXUS from Vanguard. Think of this as your anchor in the entire world outside the US, giving you a slice of over 8,000 international companies. Now, what's so critical to get here is the job that VXUS does. Yeah, we see an 8.36% average annual return, but look closer. Its expense ratio, that tiny fee you pay each year, is just 0.05%. It's practically free. And with over $100 billion in assets, tons of investors trust it. This fund is your hedge. If the U.S. market hits a rough patch, this is the part of your portfolio that's designed to step up. Let's keep climbing. How can we build on this? Well, what if you wanted to own the entire global stock market with just a single click? That is exactly the promise of number 8, VT, the Vanguard Total World Stock ETF. This fund hands you over 9,000 stocks from the U.S., developed countries, and emerging markets. And it's delivered an impressive 11.93% average return. And here's the interesting part, because so many of the world's biggest companies are American, its top holdings look pretty familiar, with names like NVIDIA and Apple right at the top. Now we're going to pivot and focus right on the heart of the U.S. market, but with a bit of a twist. At number 7 is SCHD, a huge favorite for investors who want that powerful combo of income and growth from really high-quality, dividend-paying companies. And listen, do not underestimate the power of this thing. An average annual return over 12% from an ETF that's typically less volatile and is kicking out cash dividends, to a lot of savvy investors, that is the holy grail. You get consistent growth plus income. That's an incredibly potent mix. Next up, we have a showdown between two absolute titans of the American core, VTI and VOO. They're incredibly similar, both with rock-bottom fees. The difference? VTI gives you the entire U.S. market, large, mid, and small companies. VOO is laser-focused on just the 500 largest. And over the last 10 years? Well, that focus on the giants gave VOO a small but definitely meaningful edge in performance. That quote right there perfectly captures our shift. We're moving from just owning the market to actively trying to beat it. I mean, what if you could isolate just the companies with the most powerful upward momentum? Well, that brings us to number 4, SPMO, the S&P 500 Momentum ETF. Now, this is a totally different strategy. Instead of just buying the whole market, it zeroes in on the 100 stocks inside the S&P 500 that have shown the strongest price trends. It's basically designed to ride the winners. The real genius is in how it does this. This fund isn't just sitting there. It's built to automatically rotate into whatever is hot right now. It literally chases performance. And the result? A whopping 18.51% average annual return over the last decade. And this just shows you the power of that strategy perfectly. While the good old S&P 500 delivered a fantastic 15.26%, the momentum-focused SPMO squeezed out an extra 3% per year on average just by concentrating on what was already working. We are now entering some seriously thin air at the top of our climb. At number 3 is an absolute legend, QQQ. This one tracks the NASDAQ 100, the biggest, most innovative non-financial companies out there. This is a really concentrated bet on the engines of growth, especially in tech. And that focus has paid off big time, delivering an average annual return of over 20% for a full decade. It's a staple for a lot of people. as long as you can handle the ride. So if QQQ is a big bet on innovation, what if you wanted to go all in and bet only on technology itself? Well, that's our number 2 performer, VGT, Vanguard's Information Technology ETF. This is pure, straight-up, undiluted tech exposure. See, unlike QQQ, which has a few non-tech companies, VGT is nothing but tech. Over 300 software, hardware, and semiconductor companies. And the reward for that intense focus? An insane 22.96% average annual return. Just think about that for a second. Almost 23% a year, every single year for 10 years. And now, we've made it. The peak, the number 1 performing ETF of the entire last decade. It's a fund that just blew everything else out of the water by betting on the single most critical industry of our time, semiconductors. Meet SMH. This is a high-conviction, super-concentrated fund. It only targets the 25 largest semiconductor companies, the very companies building the backbone of the AI era. Yeah, the expense ratio is a bit higher, but the performance? Well, it's in a completely different league. 33.27%. On average. Per year. For an entire decade. That really says it all, doesn't it? Even when you factor in the bad years for the market, like 2022, the average has just been staggering. It's a powerful testament to just how transformative the semiconductor industry has been. So, after that intense climb, what's the blueprint? What are the big takeaways from this ascent up the performance ladder?
Okay, first, a global anchor like VXUS gives you that crucial foundation. Second, the US market, whether you go broad with VTI or focused with VOO, is still a powerhouse core. Third, you can layer in factors like momentum with SPMO or whole sectors like tech with QQQ to really boost growth. But, and this is the big one, as we saw with SMH, the highest returns often come from higher concentration and, you guessed it, higher risk. The last decade clearly belonged to tech and semiconductors, so the real question is, what's going to define the next one?